Now let's start with information and communication technology. The creation of a single regional ICT market is the most pressing objective of the ongoing East African of the East African Communication Organization conference. Now that essentially entailed harmonizing postal, telecommunication, broadcast and ICT regulatory bodies to create uniform and efficient service and content delivery right across East Africa. Among the things that are listed as critical for East Africa's growth are more investment in the development of relevant content in local languages, the transition to digital TV broadcasting and the establishment of a functional cyber security system. Even though the region is home to some remarkable applications like those linking farmers to markets, sources of farm inputs and expertise through very basic feature phones, there still is a clear delivery gap due to language, access and information barriers across the continent.
Research has established a clear relationship between extreme poverty, ignorance, disease, hunger and poor living standards in Africa to lack of access to information. Sub-Saharan Africa, to date, has the highest incidence of poverty globally. According to the World Bank, 48.5% of the population in Sub-Saharan Africa live on less than $1.25 a day.
ICTs have been identified as key drivers of all our economies, and broadband is the root. Throughout history, Africa has lagged behind in many developmental spheres. This should never be the case anymore. ICTs present to us a unique opportunity to leap and catch up with the rest of the world. I am glad the governments in the region have acknowledged this and have put in place strategies to make the region fully connected to high-speed networks.
From Nairobi to London, ministers from across Africa, investors and mining executives have gathered in the city for a two-day conference on the mining sector in Africa, which aims to help improve stakeholder relationships. Now, though ministers attending the event are pretty keen to attract fresh capital and investments to the mining sector on the continent, they're just as keen to stress that communities in Africa must be protected from environmental damage of the sort we've seen in Ghana, for example, and they should also benefit from natural resource extraction. Our UK correspondent Natalie Ferry filed this report.
Mining ministers from Kenya, Cameroon and Zambia were among those participating in the Mining on Top summit in London, where they showcased why their growing mining sectors offer attractive investment opportunities.
We are working with the World Bank on structuring the sector in the way that there's transparency in the issuance of permits and control of activities.
The Marikana massacre following strikes at mines in South Africa is still fresh in people's minds, so addressing the risks was also high on the agenda. Though ministers also wanted to emphasise that economic and social benefits must be shared with local communities.
Africa does not need any more aid. Africa needs genuine and trustworthy partnerships, and mining. These are resources that Africa needs to develop and benefit for its people.
The UK wants to show it can do just that.
It's not just going into the country and extracting, it's going into the country and training and educating and transferring the skills, the tremendous skills we have in the United Kingdom. It will be investment in the infrastructure, a quality investment in the infrastructure.
And by hosting the event here in London, the UK has also highlighted the benefits it could bring to Britain. The UK is certainly keen to secure more mining contracts in Africa and hopes that with British companies providing financing and expertise, Africa's booming commodity sector will help boost Britain's economic recovery. Though competition is getting stiffer.
Americans are there, Chinese are there, Southeast Asia are there, the Middle East is there, Russia is there. So the scope of investors are many nowadays.
The mining sector is expected to continue to be lucrative. Ensuring local communities also reap the benefits will need to be a major focus of those looking to tap the market. Natalie Ferry, CCTV, London.
Investors are being urged to fund early-stage businesses in order to increase the number of small and medium-sized enterprises across Africa. Those at least were the findings of a report released by the Aspen Network of Development Entrepreneurs on the state, quite literally, of global small businesses. In its report, ANDE recognized that supporting early-stage businesses could potentially be the key to creating a stronger pipeline of successful SMEs and job creation right around the world. At the moment, just about 6% of small and growing businesses focus funds on the startup sector. Access to business loans and credit is also a challenge, with some 60% of micro, small and medium enterprises in emerging markets underserved by commercial banks. Now, the report also showed that women-owned businesses face many more hurdles than their male-owned counterparts, citing the fact that female business owners often lack expansive networks and reliable mentors. It also noted that more than 2 billion people in developing countries depend on agriculture for their livelihoods, yet the small businesses that connect them to the markets are often hindered by unskilled managers and a lack of financing.
In the East African context, we have lots of brilliant ideas, lots of brilliant entrepreneurs, and they're not able to, even these ideas don't see the light of day because they don't find people who are able to invest in them the amount that they need, usually small amounts, to test the concept and see if it's even viable to take it forward. So one thing that is really needed is finance at the very, very early stage, and we are really encouraging a lot of philanthropic capital to come in at that stage where you can help an entrepreneur test out their concept and their business model before they even start looking for customers and revenue.
In a lot of data that's out there, the number one constraint to businesses is access to finance. However, access to finance is not just a matter of banks not wanting to lend or not being able to lend, although that is an issue. It's also a matter of the SME's own capability to understand how much finance they need to make a proper business plan to really manage capital. And so we kind of come in at both of these ends where we're supporting, we're working with investors that want to invest, and then we're building the capacity of these SGBs so that they're becoming able to absorb this finance.
Time for a short break on BizAfrica. Here's what's coming up next. Tapping into business travel, EG Group and Lonro will be rolling out dozens of budget hotels across Africa. We'll be diving deep into that in detail when we return.
Talking tough on trade, conflicts over currency, and connecting economies around the world. From Tokyo to Shanghai and Mumbai, BizAsia links you live to the markets and brings you all the latest in business from China's unique perspective. BizAsia, a smart investment for your time.
Welcome back. Now, so far in 2013, outward expansion and, if you happen to be in Nigeria, tapping corporate debt markets have been among the key trends in the sub-Saharan banking sector. In the first half of the year, for example, Nigerian banks provided roughly half of the Dangote Group's 7-year, $3.5 billion syndicated loan for investments in fertilizer and oil refinery projects, both greenfield, for matter of fact. South African banks, on the other hand, are seeking to expand right across the continent as well. You've got South Africa's First Rand eyeing one of the banks which are restructured and recapitalized in Nigeria in 2011. Tonight, we'd like to look at the big picture in sub-Saharan banking and to look at the trends that have been in the limelight and those also that haven't. To examine that in detail, we're now joined in studio by George Bodo. He heads the financials desk at EcoBank's research division in the Kenyan capital, Nairobi. He's live in studio tonight. George, thank you so much for your time. Let's start with a pet project of yours, been looking at Rwanda in depth over the last couple of weeks. On the basis of return of equity and also the cost of income ratio at 71%, ROE somewhere around 13%, these figures are quite literally the least efficient in East Africa. What's the problem? Is it a management issue or just a question of scale?
I think it's a function of two key things. The first being a function of cost, and then also a function of the yield on earning assets in the country's assets. especially Rwandan franc-denominated assets. And I think when you look at the note that we did on the Rwandan banking sector, we brought out the fact that the yield on earning assets, specifically Rwanda local currency assets, really low yielding. And so it explains the bit of the fact that the banking sector in the country trails its major East African EAC peers in terms of profitability. So, for example, the yield on the government treasury, the benchmark government treasury bills, about 7%, average about 7% in 2012. And if you look at Kenya, for example, which was the most profitable banking sector, the same treasury bill was yielding 12 to 13% on average terms. It's almost double what was yielding in Rwanda. And then if you now delve into the cost aspect, really it's true. You know, Rwandan banking sector, the banks in Rwanda, 9 of them, and they're the least efficient in East Africa. And I'm talking about cost-to-income ratio of about 71%. If you go to Kenya, it's about 57% at the close of 2012. Uganda and Tanzania is 60%. It's an aspect, for me, it's an aspect of the fact that Rwandan banks, you know, if you go back to the history, you know, the government has been divesting slowly and slowly. And if you try to look at the government majority shareholding in a bank, government doesn't talk efficiency most of the time. So the government is slowly divesting, and I think Rwandan banks are embracing technology and efficiency going forward. And I think they need 3 more years before they can catch up with the EAC peers.
Indeed. Let us move on to another concept that has cropped up of late, the problem of concentration. If you look at Senegal, for example, off World Bank data, about 5 borrowers account for about 58% of the entire banking sector's assets. Now, despite all the high profits that we're seeing in some sub-Saharan African countries, isn't this concentration of assets in and of itself a pointer to a bigger problem about competition?
It's true, absolutely. And I think I have tried to highlight a bit some of this, that there's a big issue with concentration risks, especially in sub-Saharan Africa. And I will give you an example. In East Africa, for example, in Rwanda, to be specific, top 3 banks run about 80% of the market's total assets. And if you bring it to Kenya, we've really tried to work on it. Top 5 run about 54%. And if you go to Uganda and Tanzania, it's about 60%. I think if you go to Nigeria, the top 5 banks do about 54% of the banking sector index. And just to highlight the risk in that, you know, the problem with that is that if anything goes bad with one of the banks, if something crystallizes unforeseen, that the possibility of that crystallizing into a whole banking crisis is very high. And it's the same thing with the concentration in terms of borrowers. You know, the central banks across South Africa, sub-Saharan Africa, they're really trying to enforce the concept of single obligor limit, that you should not overexpose yourself so much to certain clientele, you know, or a certain number of clients, you know, borrowers. And the problem is it's still persistent. It's still evident, more pronounced across Sub-Saharan Africa, and I think it's going to boil into some issue. It's not an issue of competition. I think it's an issue of, you know, sectoral appetite. You know, for example, I can tell you, if you go to Nigeria, there's a huge exposure to the oil and gas, and that is where banks make serious margins. So it's an issue of sectoral appetite. If you bring it to Kenya, so many banks are exposed to personal and consumer lending, and it's going to be a big issue, especially if borrowers can't keep up with their payments. It can be a big issue. If you go to Rwanda, there's a huge exposure to mortgage and tourism sector. So I think it's a question, it boils down to sectoral appetite and the margins, because at bottom line, banks really want to create more value for their shareholders.
Finally, George, let's talk about ABSA and Barclays. That deal has essentially occupied a lot of attention as far as the media is concerned in the first half of the year. To quote ABSA CEO Maria Ramos, it's not going to be a walk in the park getting into 8 sub-Saharan African countries. What teething problems do you expect as they work on finalizing the deal?
I agree with this here. It's not going to be a walk in the park. You know, ABSA is a predominantly South African bank, and most of its operations in South Africa is a strong retail presence in South Africa. One of the things, and I think I've tried to highlight this before, is the fact that there's going to be an issue with expertise. You know, they don't have sub-Saharan African expertise ex-South Africa. You know, these are very challenging banking terrains. If you talk about countries like Kenya, very challenging, you know, highly sensitive consumers, you know, banking moving a lot to mobile banking, you know, a lot of innovation taking place in some of these markets. When it comes to, you know, expertise outside South Africa, it's going to be an issue. I think they're going to have to work on that. I don't know how I'm going to do it, but I really have to work on honing the expertise of South Africa, because some of these banking terrains have different dynamics, completely different from South Africa.
Indeed, a question of local talent and local cultures. We'll have to leave you there for the time being, though. Thank you very much for your time. That's George Bodo. He runs the financials research desk at EcoBank Research right here in the Kenyan capital, Nairobi. Now, let's move on to broadcast media. The Beijing International Radio, Television and Film Company has expressed quite a bit of optimism about the broadcast opportunities available in the African continent as a whole, following a year of trials of its various products. Now, while exhibiting for the very first time in Africa in an exhibition being held in the Kenyan capital, Nairobi, the company said its response so far was quite encouraging, and that in turn has provided for increased integration between China and Africa. Now, the deputy manager at the exhibition department said that Chinese products and services are growing in popularity in Africa, primarily due to their affordability and capacity to address specific African problems. Already, StarTimes, one of the companies under the BIR TV umbrella, is supposed to be a market leader in pay television services in the 9 African countries in which it operates in just over a year since it started its services. Now, United Nations and Arab League conference has been held in the Egyptian capital of Cairo, aimed at setting the agenda to address a problem associated with rapid population growth. The Arab region as a whole has some 300 million inhabitants, and it has the fastest growing population in the world, with unemployment running at 25%. With the details, here's CCTV's Yasser Hakim.
Economic slowdown, demographic changes and lack of planning have all led to a rise in shanty towns and low quality of social and other services for populations in many countries of the Arab region. This was one of the main issues on the agenda at the Arab experts meeting in Cairo.
There are 7 challenges, mainly gender equality, fair distribution of the population, better quality and awareness of the population, and most importantly, development of the youth.
The Arab region has the fastest growing population in the world at 2% per year and the highest ratio of youth to the population. These are seen as positive forces, but countries are not making the most of this vital resource.
Unemployment is at an average of 25% in the Middle East. Most of the available workers are not well trained. There has been a massive brain drain to the West and immigration of skilled workers as well. Arab scientists abroad can be the catalyst for technological development in the Arab world.
The remittance from expats abroad back to the Arab region has been estimated at $487 billion in the last 10 years. Experts say a lot can be invested with this money.
We have the funding and the workforce. The plan requires improving labor quality through extensive training. We will also encourage and fund more small and medium enterprises, the backbone of any successful economy. This will improve the standard of the population.
Analysts say the latest revolutions in the region aimed at social justice and better living conditions have been followed by political instability that has delayed progress on population development.
The conference in Cairo in 1994 has set 2014 as a deadline for population development, but the problems of population are still the same. This is why a new deadline has been set by the UN to be under a new post-2014 action plan. This is Yasser Hakim for CCTV, Cairo.
Londra Hotels says it wants to revolutionize the business travel market in Africa with a business plan focused on low-budget hotels. Now, that's based in part on the Easy Group's low-cost business model to make it easier to more people and more accessible to a wider market. Londra started the rollout of its Easy Hotels brand in Africa with the launch of its first hotel in Joburg, South Africa. CCTV Sumitra Naidu spent the day with Londra Hotels Chief Executive Ewan Cameron, and she filed this report.
Londra's first Easy Hotel opened its doors in the Johannesburg CBD just over a month ago and has already recorded an over 90% occupancy rate. The hotel is basic but comfortable and is the first of 50 new low-budget hotels to be opened across the continent by 2016.
Our focus is the high-growth business markets of the continent. Our key client is business travellers. So we've done research on where they're travelling, and from that we've identified where the key nodes are. So to us, Africa is really 35 high growth nodes.
Cameron has for years worked extensively with global research group McKinsey. He's also a firm believer in Africa's growth potential. But the hotel industry is tough, especially in parts of Africa where infrastructure is poor and energy costs are high. But Cameron says there's still a business case.
We're already in a position where there are more SMEs opening in Africa today than potentially in other parts of the world. You can see it by the transit and the movement of people around the continent. You can see the access of mobile phones. You can see the usage of internet around the continent. The growth of small and medium-sized businesses is exponential on the continent.
With Africa's economic prospects looking healthier, the business traveller has become an increasingly important pull factor for revenue growth in the hospitality industry on the continent. And this is where Londro is focusing its efforts. While the group has a few luxury hotels in its portfolio, it believes the businessman is more important. Staff are trained to provide business travellers with all the essentials to facilitate easier access to doing business in Africa. Africa is home to some of the most attractive investment destinations in the world. McKinsey research shows a growing middle class and rising disposable incomes, making Africa a business hub with people constantly on the move. But Africa has its fair share of political instability. But this hasn't deterred Londro from going into hot areas like the DRC. Londro runs 5 hotels in the country.
We really see the DRC as a long-term story. There are short-term challenges, there's short-term uncertainty. But we do take some confidence with regard to what's happened here in 2013, with regard to peace treaty on the Rwandan border. There seems to be some sense of stability appearing on the east coast, on the east border. If that materialises, we then think that the DRC has all the capacity to be very successful.
With Africa now one of the fastest growing continents in the world, Londro is well placed for growth. And with the impending launch of its low-cost airline, FastJet, the group is providing easier and cheaper access to Africa. Sumitra Nadu, CCTV, Johannesburg.
Now, before we jump into the details about the Rugby World Cup, which is starting on Friday, depending on which part of the world you're on, let's make a quick run through the markets. Still a bit of that sideways movement we're seeing, depending on which part of the continent you're looking at. The Nigerian All-Share Index ending the day higher, up about a 4 percentage point. The All-Share Index in South Africa also in the green, but only marginally so, by just about a tenth or so. The 20-share index in Nairobi, though, still very much in the grip of that bear run that we've seen for the last couple of sessions, down by just over a third. And the Egyptian market rounding out the numbers in the green, up 0.95%.